Hey there and welcome back to Savvy Nomad's channel. In today's video, we're going to talk about something that's been in the news a lot lately, and that's the so-called One Big Beautiful Bill Act that was just signed into law by President Trump. This is a major new tax law, contains a lot of changes to the tax code, but here we're just going to talk about the changes that pertain to US expats and taxpayers that are living overseas. But before we do that, do us a solid, make sure you hit that like button. It really helps us out in the algorithm so we can get this content to more people who really need to see it. So with that said, let's dive into the new tax law. First, we'll begin with the positives. The bill contains a lot of provisions that could prove very beneficial for US expats and taxpayers living overseas. But one thing that has not changed is the Foreign Earned Income Exclusion, other than the previously scheduled increase from $126,500 to $130,000. The Foreign Earned Income Exclusion is one of the most important tax provisions for US expats. Remember that it allows taxpayers who are living overseas to exclude a certain portion of their foreign earned income from US federal income taxes. To qualify, you must meet either the physical presence test or the bona fide residence test, and we talk a lot more about that in our full video on the Foreign Earned Income Exclusion, so make sure you check that out. Link is in the video description. Now, one important change that the tax bill brings is the increase in the state and local tax deduction. If you're an expat that still pays state taxes, the bill increases the SALT deduction cap from $10,000 to $40,000. Now, being Savvy Nomad, we obviously recommend that US expats change their domicile to a zero tax state, such as Florida. Here at Savvy Nomad, we specialize in facilitating that process. It's what we do. So if you're interested in learning more about how you can save thousands of dollars in state income taxes, make sure you check out that link in the video description and use the code YouTube for 15% off. Now, those were the positives. So let's now talk about some of the downsides. The first is the new 1% remittance tax. This tax will now apply to any outbound money transfers from the US starting in 2026. Now, this tax is specifically for transfers made using cash money orders or cashier's checks. So if you're using a US issued debit card, credit card, or ACH transfer, you don't have to worry, these changes won't apply to you. But if you don't have access to a US bank account or you're using non-bank money services, then this could affect you. This really underscores the importance of why getting or keeping a US residential address is extremely important, and this is something that Savvy Nomad can help you out with. Again, check out that link in the video description. Another change you need to be aware of is with the child tax credit. To claim the refundable portion of the credit, at least one parent on a joint return and the qualifying child must both have a valid US Social Security number. Now, if you don't have one and you're an expat who has a dual citizen child, you don't have a US Social Security number, this could be a problem. Now, as a reminder, these changes only affect the 2025 tax year, so you won't need to worry about any of this until you file in 2026. So if you want to keep on top of any new changes, make sure you get on our new weekly newsletter. Link is in the video description for that. We'll keep you updated on any new developments. If you enjoyed this video, you want to learn more about nomad tax strategies and financial tips, make sure you subscribe to our channel. And again, hit that like button. It helps us out in the algorithm so we can keep bringing you this content for free. Until next time, safe travels and happy tax planning.